Chris McCauley with the Strategic Planning Group. It's early April 2022, and I'm going to give you a quarterly update on the stock market, bond markets, interest rates, and inflation. 2022 so far has been rough for the stock markets and very rough for bond investors. The Standard & Poor's 500 index is down 4.6% through March 31st. It represents 500 large U.S. stocks. International developed markets, as measured by the MSCI EAFE, has decreased by 5.9%, while the emerging markets were down 6.9%. Enough of the numbers, let's talk about what's going on. The Barclays Aggregate Bond Index is down 5.9%, which is worse than the S&P 500 so far. This is due to rising interest rates. In short, when interest rates rise, bond prices fall, which is why the bond market has fallen. Thus far in 2022, the U.S. stock market is doing better than the U.S. bond market. This is a very unusual event caused by the Federal Reserve's intention to raise interest rates significantly this year. After the best 3 years since the late 1990s, the S&P 500 has declined, but it is not wildly overvalued like it was in the late 1990s. As you recall, in the early 2000s, we had 3 straight years of the S&P 500 declining. As you know from going to the grocery store, inflation is with us. Inflation is the primary reason for the Fed raising interest rates. To recap, the Federal Reserve's primary 2 objectives, given to it by Congress, are price stability, meaning control inflation, and high employment. The Fed lowered rates to near zero early in the pandemic to make borrowing cheaper to stimulate the economy. As the economy has recovered, inflation has soared for many reasons. To fight inflation, the Fed will be raising interest rates multiple times this year. The end result will be higher interest rates, including mortgage, car loan, and home equity loan rates. Money market rates, which have been very depressed due to the Fed's policy, will rise slowly as rates rise, as the Fed increases rates from almost zero. In the stock market, lower quality companies have seen their share prices fall. These companies tend to have low to negative cash flow and earnings. Higher quality companies that have positive cash flow and profits are doing much better than lower quality companies this year. Additionally, high growth companies, including many tech companies that did well in recent years, have seen large stock price declines as investors have shifted to higher quality companies. We do believe high quality stocks are a good place to be during this period of rising interest rates and inflation. We believe in diversified portfolios and investing for the long term to meet your lifestyle goals. Putting together a plan will guide you through the highs and lows of investing and provide the map to follow to keep you calm and reach your objectives. Thank you for watching our quarterly update. For more information on various planning topics, please go to the Strategic Planning Group's LinkedIn page and like our posts. We work with a number of clients to tie their investment portfolios into a robust retirement plan. If you would like to see if we can do the same for you, please drop me a line at chris@spgfinancial.com or call at 317-806-3083. We look forward to hearing from you.